If I told you there is an investment portfolio that looks like it's thrown together in 5 minutes, and it still beats the experts who spend their entire career fine-tuning spreadsheets, you probably think I'm joking, but I'm not. Because the portfolio I'm talking about, the 25-25-25-25 permanent portfolio, has been quietly outperforming the classic 60-40 strategy and the S&P 500 this year. Yeah, the one that looks like a kindergarten math problem. So today, we're breaking down why this weird, almost too simple strategy works, and why it might actually make more sense than the portfolios people spend millions to manage. Hi, I'm Michael, and welcome back to Open Media, where we take the things happening out there in the world, the stuff that seems complicated, and we make it make sense. If you want deep dives, storytelling, and a little factual detective work, you're in the right place. Now, let's talk about the strangest winning investment strategy of these past years. Just a quick note before we dive in deeper. Nothing in this video is financial advice. I'm not a financial advisor. This is purely educational and meant to help you understand how this strategy works. Some major publications just published a wildly interesting piece about something called the 25-25-25-25 portfolio, also known as the permanent portfolio. It was created in the 1980s by Harry Brown, an investment advisor and a two-time libertarian presidential candidate. Yes, the same guy whose followers used to herald gold and talk about abolishing the IRS. So not exactly the person you'd expect to design a portfolio that's beating major benchmarks in 2025. The strategy is simple: 25% stocks, 25% bonds, 25% gold, 25% cash. That's it. No fancy risk models, no spreadsheets from Mel, no we optimize volatility correlations. Just 4 slices of the pie, perfectly equal. It shouldn't work, but this past year, it's beating the professionals. Here is how things stacked up in 2025. The S&P 500 plus 14%, the classic 60-40 portfolio plus 10%, the 25-25-25-25 permanent portfolio plus 16%. Yes, the I made this during lunch strategy is outperforming the portfolios built by people who think in basis points. Zoom out to the bigger picture. Since 2020, permanent portfolio plus 9% per year. Classic 60-40 plus 9% per year. Globally, permanent portfolio plus 8% per year. Classic 60-40 plus 6% per year. It's not blowing anything out of the water, but it's quietly consistent and less risky. And that's what makes it interesting. According to traditional finance theory, this portfolio breaks all the rules. Rule number 1. Only overweight things that produce cash flow. Stocks and bonds do, gold and cash don't. Rule number 2. Weigh asset based on expected returns and volatility. The 60-40 portfolio is built from an idea. The 25-25-25-25 portfolio basically rolls dice and it calls it a day. But there is method here. The permanent portfolio is built around the idea that something in your portfolio should be winning no matter what's happening in the economy. The whole strategy revolves around 4 main economic conditions. 1. Expansion leads to stock win. Companies grow, earnings beat expectations, easy. 2. Deflation leads to bond win. Prices fall, interest rates drop, bond values rise. 3. Inflation leads to gold wins. This is why gold bugs have been screaming for 40 years, and for once, they're not wrong. Recession leads to cash wins. Not for returns, but because having cash lets you buy everything on sale. It's basically whatever happens, at least one thing in the portfolio should be partying. And this past year, gold has absolutely exploded. Up 50% this year, 2.5 times since 2020. Suddenly, that weird 25% gold allocation looks pretty smart. This part shocked me. A 2014 study looked at 40 years of return across 11 different countries, and here what it found. The permanent portfolio had smaller losses during the worst 5% of months. The Sharpe ratio, risk-adjusted performance, was better than traditional 70-30 portfolios. Over long periods, the returns held up consistently. In other words, it's not just about hedging, it actually performs efficiently. It's simple but not stupid. Sometimes not taking things too hard actually works. Let's do a classic breakdown based on the math. Pros: simple, you could set it up in 10 minutes, diversified across economic conditions, lower risk and volatility, historically strong risk-adjusted returns. Cons: lower upside in booming stock markets, 25% goals feels weird to many investors, 25% cash may underperform inflation, not optimized for maximum long-term growth. If the goal is stability, protection, sleep at night safety, then honestly it works. If your goal is maximum growth, beating the market long term, then the S&P 500 is still the simpler and higher upside option. The permanent portfolio is eccentric, unconventional, and almost annoyingly simple, but it works far better than people expect. So the real question isn't, is this strategy perfect? It's, do you need a portfolio that wins big or one that wins consistently? If you like videos that help make sense of the world, from economics to science to history to geopolitics and more, join me here on Op-Ed Media. Thanks for watching, and I'll see you on the next one.